Well, as reported by CNBC-TV18 last month, the IRDA is likely to finalize product regulation norms. Now, CNBC-TV18 now learns that the IRDA board meet today may take up the product regulation and may also give first-level nod to Indiabulls for its general insurance business. Yash has been on top of that. He's joining in with all those details. Yash, what are the norms likely to be?
What we're given to understand is that insurance companies could be allowed to charge extra or additional premium to their policy holders for any rider or top-up which they want to buy over and above their existing ULIP or unit-linked policies. Do remember, right now, ULIP units or unit-linked units are deducted against any top-up or rider which is bought by a policy holder. Over and above is unit-linked policy. So that is one important regulation. Apart from that, we are also given to understand that insurance companies may be allowed to do away with the provision of minimum capital guarantee, which they of course commit to the policy holders in certain business segments, including the pension segment. Essentially, this will give them more freedom, more independence to play with their investment pattern, to invest more in equity, to invest less in debt, and so on and so forth, depending on the situation, and not just concentrate on focus on investing in debt instruments in lieu of fixed returns which they have to pay to their policy holders. Apart from that, we are also given to understand that insurance companies may allow their policy holders a partial withdrawal of up to 25% when it comes to their pension policies. This will be very important because at this point of time, no partial withdrawal is allowed by policy holders as far as these pension policies are concerned. What we're given to understand is that IRDA may allow insurance companies to have this partial withdrawal of up to 25% in situations like education, marriage, home rent, so on and so forth. This is as far as the product regulations and the overall there is concerned. But of course, a very important business approval also expected in today's board meeting, and that would be for Indiabulls Integrated Services general insurance business. We had reported that the company had filed for its papers in January, and today we are given to understand that it might be given its first level approval or R1 for the general insurance business. As far as the entity itself is concerned, it's a wholly owned subsidiary of Indiabulls Integrated Services, which will look to start its general insurance operations with a minimum capital of 100 crore rupees. But of course, the parent, which is Indiabulls Integrated Services, will also have to keep a reserve capital of 500 crore rupees for the purpose of further funding as far as the general insurance business is concerned.
Thank you very much for that. Get into a break. As we do that, we leave you with some market opinion coming in from Arvind Sanger of Geosphere Capital Management.
Recovery from some of the weakness that we've seen in some of the fundamentals that have been, that have been somewhat disappointing in terms of, auto sales, commercial vehicle sales, and other economic measures which have looked weak. The assumption is that that will recover, and all of those can give us an upside of 20 to 25% in the Indian market if the economic outlook in FY20 delivers, reasonably good growth. We won't look for fantastic growth, but 10 to 15% growth will give us that kind of outcome. Our central case is, very modest slowdown, but not a recession in the West, in which case we're more inclined to buy into weakness rather than be selling strength. India is fine as long as it's a global slowdown and not a full-blown recession, because India does well when it's growing on a relatively attractive basis, and global liquidity is fine, which obviously with the Fed stopping raising rates, looks like liquidity is not a problem. So I think, to me, the Goldilocks for India would be no recession in US or Europe, easing of liquidity conditions by central bankers both in Europe and the US. We're actually finding some of the NBFCs that have been extremely badly hurt to be a little bit more interesting. Those NBFCs had gotten very expensive, and we had traded off all of them last year, but some of them have come back to levels where I think that some of them are now trading at discounts to some of these banks. And yes, their growth will not be quite as heady as before, but that is another area where investors should look at some of the higher quality NBFCs that have gotten sold off.